In our daily lives, we often make choices based on what we perceive as valuable, whether it's selecting a piece of fruit at the grocery store or deciding on a new car. The concept of value plays a pivotal role. But have you ever wondered what truly defines the worth of something? That's where the notion of intrinsic value comes into play. That's where intrinsic value comes in. It's like uncovering the true worth of things, and it's more than just what you see on the surface. In this video, we'll teach you how to use intrinsic value to discover stocks that might be worth more than their current price. You can do this for a quick profit or to hold on to them for a long time. We'll break it down step by step and use simple examples to show you how to figure out intrinsic value using two strategies. In the end, I'll show you when to use which strategy and how to combine the two strategies to find the next Warren Buffett Coca-Cola stock for you. So you can replicate how Warren Buffett made over $25 billion from his $1 billion investment in Coca-Cola in 1988 simply by recognizing that the stock was undervalued. Or in other words, it had a higher intrinsic value. To get a full understanding of intrinsic value, let's compare it to market value and talk about the difference between the market value and the intrinsic value of a stock. Imagine you want to buy a toy. The toy store says the toy costs $10, but you think it's worth $15 because it's a great toy. Here, $10, the price the store is selling it for right now, is called the market value. This price can change depending on what people feel like paying for it. If many people want it, the price may go up. If not, it might go down. But you believe $15 is what it's truly worth on how cool it is, its quality, and everything it can do. This means instead of $10, this toy for you is worth $15, which is called the intrinsic value. Now, why does this matter for stocks? When you buy a stock, you want to make sure you're getting a good deal. Just like the toy, market price is what the stock is selling for right now. It can go up and down because of what people think about the stock, not necessarily what the company is really worth. Financial analysts use various models to estimate the true value of a company by analyzing a company's fundamental factors like its cash flow and assets. What the company is actually worth is based on things like how much money it makes and its assets. That's the actual worth of a company or stock. And likewise, it's called the intrinsic value of a company's stock. So why care about intrinsic value? Here's the key. The difference between the market price of a stock and its estimated intrinsic value is an important measure for investors. When the intrinsic value is higher than the market price, it's considered undervalued, and when it's lower, it's seen as overvalued. This information helps investors make informed decisions, and they often aim to buy stocks with a margin of safety, meaning the market price is below the estimated intrinsic value. For example, if you find a stock selling for $44, but you believe it's really worth $65 because the company's doing well, you have a good chance to make money. You're getting a bargain. But remember, the market can be unpredictable, so it's like having a cushion. If the stock's intrinsic value drops a bit later on, you still have room to make money because you bought it at a lower price. Understanding intrinsic value helps you make smart decisions when you invest in stocks. The next logical question is, how do you calculate the intrinsic value of a stock? There are multiple approaches to calculating the intrinsic value of a stock, but one of the most commonly used methods are the discounted cash flow model and relative valuation. It sounds a bit confusing, but I'll try to explain it as simply as possible. First, and the relatively easy method, is the relative valuation. This is a method of valuing a company by comparing it to other similar companies. Think of it like shopping for a car. Instead of calculating what the car should be worth based on its parts and performance, you look at the prices of similar cars in the market and make your decision based on that. It's a way to see if a stock is cheaper or more expensive compared to its competitors. When using the relative valuation, investors rely on certain ratios to compare companies. One of the most common ratios is price-to-earnings ratio, PE. where P stands for the price of the stock and E stands for earnings for the share. P/E ratio shows how much investors are willing to pay for each dollar of earnings. A high price-to-earnings ratio might mean the stock is overvalued or that investors expect high growth, while a low P/E ratio might suggest undervaluation. Let's say you're comparing two companies in the technology sector, Tech A and Tech B. Tech A's stock is currently trading at $60 per share, and its earnings per share stand at $4 per share. Meanwhile, Tech B's stock is priced at $100 per share with an EPS of $5 per share. Calculating their price-to-earnings P/E ratios, Tech A has a P/E ratio of 15. That is 60 divided by 4, $60 divided by $4. While Tech B's P/E ratio is 20, $100 divided by $5. Comparing these to the industry average P/E ratio of 18, we observe that Tech A has a lower P/E ratio, indicating that investors are willing to pay less for each dollar on its earnings compared to the industry average. Tech B, on the other hand, has a higher P/E ratio, suggesting that investors are willing to pay more for each dollar of its earnings. This may indicate that Tech A is relatively undervalued compared to Tech B and the industry average. And that would suggest that the Tech A company is a buy, and you should avoid the Tech B right now as it's not a good entry point. This is the simplest way of calculating the intrinsic value of a company's stock. It's easy to understand, it's based on current market perceptions and trends, and also useful for understanding a company's position within its industry. But there are some drawbacks to this method. Sometimes the entire market or sector might be overvalued or undervalued, affecting the reliability of these ratios. Companies may have different accounting standards, making comparisons tricky. Also, it doesn't consider the company's unique circumstances or future growth prospects. So, in essence, relative valuation is like using a compass rather than a detailed map. It gives you direction based on where others are going, but doesn't show the entire path. It's a useful tool, but best when used in conjunction with other methods like DCF for a more complete picture of a company's value. In the end, we'll show you how you can combine the relative valuation model with the DCF method and when to use each one, so you can invest in the perfect stock. Now, here's a simplified step-by-step guide to calculating the intrinsic value of a stock using the discounted cash flow valuation, or DCF method in short. This valuation method calculates the value of a stock based on its expected future cash flows. Think of it as trying to figure out how much a money-making machine is worth today based on the money it'll make in the future. DCF is especially relevant in stock valuation as it provides a way to assess the value of a company's stock based on its future earning potential. To perform a DCF valuation, you need to understand three key components: cash flows, discount rate, and terminal value. Cash flows are the amounts of money a company is expected to generate in the future. It's like predicting how many eggs the hen will lay each year. Discount rate is the interest rate used to discount future cash flows back to their present value. It accounts for the idea that money available today is worth more than the same amount in the future because of its potential earning capacity. It's like adjusting the future value of the eggs based on factors like inflation or the risk that the hen might not lay as many eggs as expected. Lastly, terminal value represents the value of the company's cash flows beyond the forecast period into perpetuity, assuming a stable growth rate. Let's walk through a simplified DCF calculation. Suppose you're evaluating a company, Future Tech, that has a current stock price of $11 per share. You predict that Future Tech will generate $100,000 in cash flow next year and that these cash flows will grow by 5% each year for the next 5 years. Assume a discount rate of 10%. The first step is to calculate future cash flows. For each of the next 5 years, calculate the expected cash flow. For instance, the cash flow at the end of the first year is $100,000 times 1.05, which is 5% growth. For the second year, it's last year's ending, which is $110,250 times 1.05, and so on. You should get these values for all 5 years. The next step is to discount the cash flows. Each of these cash flows needs to be discounted back to their present value using this formula. For example, the first year's end cash flow is discounted as $105,000 divided by 1 plus 0.10 to the first power. The second year's as $110,250 divided by 1 plus 0.10 to the second power, and so on. You should have values something similar to this table. Next up is calculating terminal value, which is the growth of the company after 5 years. After the 5-year forecast, estimate the terminal value. Suppose you assume the cash flows will grow at 3% indefinitely after year 5. The terminal value at the end of year 5 can be calculated using a formula involving the last cash flow, the perpetual growth rate, and the discount rate. Just put all the values in this formula, and you'll get the terminal value. Just like the yearly cash flows, discount this terminal value back to its present value. Next, simply add them up. The sum of the discounted cash flows and the discounted terminal value gives you the total DCF valuation of future tech, which, in our example, is $1,601,877. So if this company has 100,000 outstanding shares, the value of one share should be $1,601,877 divided by 100,000, which is $16 per share. But at the start of the example, this stock, Future Tech, had a current stock price of $11 per share. But from our calculation, we can see that it has an intrinsic value, or should be valued, at $16 per share. So we know this stock is currently undervalued and is a good buy for making money. DCF is not quite as simple as relative valuation, but it also focuses on future performance, not just current or past data. It also allows for detailed analysis of a company's prospects and the impact of different factors. But like any valuation model, there are some limitations to this method too. It's sensitive to assumptions. Small changes in inputs, like the discount rate or growth rate, can lead to big changes in valuation, and it can be complex and daunting for beginners and requires a fair amount of guesswork about the future. If the relative valuation model is a compass that gives you direction based on where others are going, DCF is a map to find a treasure. The map is helpful, but you have to make sure you've used the right parameters. Here are the practical tips for using both methods. To effectively use both DCF and relative valuation, start with relative valuation. It's a quick way to get a feel for how the market is valuing similar companies. This can be your starting point, giving you a baseline for future analysis. Once you have a basic understanding from relative valuation, use DCF for a more thorough and company-specific analysis. This helps in understanding the unique aspects influencing a company's value. Use the results from one method to check the other. If DCF shows the stock is undervalued, but relative valuation suggests it's overpriced compared to peers, investigate why. There might be specific factors at play worth understanding. Perhaps the whole industry is overvalued, which is why we're getting the relative valuation suggestion of undervaluation. Although it's good to use both for general stocks, some industries, stocks, or companies might not fall into that category. Understanding when to use discounted cash flow valuation and when to rely on relative valuation is key to effective stock analysis. DCF valuation is ideal in the following scenarios. Unique companies. For companies with no close competitors or those in a niche market. It's like having a one-of-a-kind vintage car. Its value isn't easily compared with others. Stable cash flows. When a company has predictable and stable cash flows. It's akin to a steady and reliable income source, easier to forecast and value. Long-term analysis. For long-term investment perspectives, especially if you're more concerned about a company's future potential than its current market status. Relative valuation, on the other hand, is more suitable in industry comparisons, when you want to quickly gauge where a company stands in its industry. It's like comparing similar models of smartphones to find out which offers better value for the money. Highly competitive markets. In industries where many companies offer similar products or services, making direct comparisons more meaningful. Quick analysis, when time is a constraint and a quick ballpark estimate of a value is needed. Valuation models, while not foolproof, provide insights into a company's financial health. Value investors prefer stocks below their intrinsic value to save money. If a stock seems overpriced, waiting for a better deal can prevent larger losses and allow for safer investments. Meanwhile, watch our video on the top 9 dividend stocks for 2024 and calculate intrinsic value along the way.